Question 1. During an emergency response where multiple areas are impacted, a business owner whose commercial property was significantly damaged by a federally declared disaster is considering whether to claim a casualty loss deduction on their tax return. The business had previously depreciated the property under the Modified Accelerated Cost Recovery System (MACRS). Which of the following statements is correct regarding the casualty loss deduction? A. The deduction is limited to the adjusted basis of the property immediately before the casualty, reduced by any salvage value and insurance reimbursement. B. The deduction is always based on the fair market value of the property before and after the disaster, regardless of the depreciation claim. C. The business owner can choose to carry forward the loss indefinitely until fully utilized, even if they do not meet any income thresholds. D. If insurance proceeds exceed the adjusted basis, the business must recognize taxable gain unless they reinvest the proceeds into similar property within 2 years. Answer: D. If insurance proceeds exceed the adjusted basis, the business must recognize taxable gain unless they reinvest the proceeds into similar property within 2 years. Explanation: under ERSSS, businesses can claim casualty loss deductions for damage to property caused by sudden, unexpected, or unusual events like natural disasters. However, several key factors influence how the deduction is calculated: adjusted basis versus market value. The deduction is generally limited to the adjusted basis at original cost minus depreciation rather than fair market value. Therefore, option A is partially correct but does not mention the impact of depreciation, making D better choice. Insurance reimbursement. If the property is insured, any reimbursement received reduces the allowable deduction. If insurance proceeds exceed the adjusted basis, taxable gain is triggered unless the business reinvests in similar property within 2 years under ERSS involuntary conversions. This makes D the best answer. Indefinite carryforward. Unlike net operating losses, NOLs, casualty losses do not have indefinite carryforward provisions, making option C incorrect. Depreciated property consideration. Since the business used MACRS depreciation, the adjusted basis is generally much lower than fair market value, which makes B incorrect, as it ignores depreciation impact. This question highlights the critical tax treatment of business casualty losses, an area frequently tested in advanced tax law exams. Question 2. In a situation where formal requirements conflict with practical business needs, a multinational corporation with subsidiaries in multiple countries is determining how to report foreign income under U.S. tax laws. The corporation has passive investments in a foreign entity classified as a passive foreign investment company (FIC) under U.S. tax rules. Which tax treatment is correct regarding the FIC status? A. The corporation can elect the qualified electing fund (KEF) method to report the pro rata share of the fixed income annually, avoiding excess distributions. B. The corporation must automatically recognize all foreign income under the Global Intangible Low-Taxed Income (GILTI) provisions with no alternative elections available. C. If the FIC does not distribute any income, the corporation does not owe any U.S. tax on the investment until sale occurs. D. FIC classification only applies if more than 75% of the corporation's total worldwide revenue is from passive sources. Answer: A. The corporation can elect the qualified electing fund (KEF) method to report the pro rata share of the fixed income annually, avoiding excess distributions. Explanation: the passive foreign investment company FIC rules are designed to prevent U.S. taxpayers from deferring tax on passive income earned through foreign entities. These rules apply if foreign corporation meets either of the following tests. Income test: at least 75% of the foreign entity's gross income is passive income. Option D is incorrect because the threshold is 75% of the foreign entities, not the entire corporation's income. Asset test: at least 50% of the foreign entity's assets are held for producing passive income. For U.S. taxpayers, FIC taxation follows harsh anti-deferral rules unless specific elections are made. KEF election option correct allows the U.S. owner to report its share of the fixed income annually, avoiding punitive tax treatment on excess distributions. GILTI versus FIC option B incorrect. GILTI applies to controlled foreign corporations (CFCS), whereas FIC rules apply to investments where ownership is more limited. Deferral misconception option C incorrect. If the FIC does not distribute income, U.S. taxpayers may still face punitive taxation if they later receive excess distributions or sell the investment. This question tests the advanced understanding of international taxation and FIC compliance, an area of frequent complexity in tax law. Question 3. While analyzing the root causes of sequential problems in tax compliance, a tax attorney is advising a high net worth client who made large charitable donations, some in cash and some in appreciated securities, to multiple charities. The client is seeking to maximize deductions while ensuring compliance with IRA regulations. Which of the following statements correctly explains the tax treatment of their charitable contributions? A. Cash donations to public charities are subject to an annual limit of 50% of adjusted gross income OGI, while appreciated securities have a 30% OGI limit. B. Appreciated securities held for more than 1 year can be deducted at fair market value without triggering capital gains tax, but the deduction is limited to 30% of OGI. C. If total charitable contributions exceed the OGI limit, the excess be carried forward to future tax years. D. Charitable contributions of over $250 require a signed written receipt, but non-cash donations over $5,000 also require a qualified appraisal. Answer: D. Charitable contributions of over $250 require a signed written receipt, but non-cash donations over $5,000 also require a qualified appraisal. Explanation: charitable deductions are governed by RSS and different rules apply depending on the type of donation and recipient. OGI limits option incorrect. The current OGI limit for cash donations to public charities is 60%, not 50%. Donations of appreciated securities held for over 1 year are deductible at fair market value but are subject to 30% OGI limit. Option B is correct in part but not the best choice because it doesn't include key compliance rules. Fair market value deduction. Option B. Partially correct. Appreciated securities are deductible at fair market value. This applies only if held for more than a year. However, if securities were held for 1 year or less, the deduction is limited to cost basis. Carry forward rules. Option C incorrect. If contributions exceed OGI limits, the excess can be carried forward for up to 5 years. Documentation requirements. Option D correct. For cash donations over $250, written acknowledgement from the charity is required. For non-cash contributions over $5,000, qualified appraisal is required to substantiate fair market value. This question helps law students master charitable contribution deductions in compliance. Crucial area for high net worth tax planning. Question 4. During an emergency response where multiple areas are impacted, a multinational corporation must determine the tax treatment of foreign-sourced income in compliance with U.S. tax laws. The company operates subsidiaries in several countries, each with its own tax jurisdiction. Given recent changes in the Foreign Account Tax Compliance Act, FATCA, and Controlled Foreign Corporation (CFC) rules, the company needs to assess whether it must report its foreign income, pay taxes on undistributed earnings, and comply with new tax treaty obligations. Which of the following is the most accurate tax treatment? Corporations, foreign income under U.S. tax law. A. The corporation is subject to worldwide taxation, meaning all foreign earnings must be reported and taxed immediately, regardless of deferral elections. B. Foreign-sourced income is only taxable in the U.S. if it is repatriated, except for income classified under Subpart F, which is taxed regardless of repatriation. C. The company can entirely exclude foreign income from U.S. taxation if it has established subsidiaries in tax treaty jurisdictions with lower tax rates. D. Foreign income taxation depends solely on the tax treaties between the U.S. and the respective foreign country, which override all domestic tax laws. Answer: B. Foreign-sourced income is only taxable in the U.S. if it is repatriated, except for income classified under Subpart F, which is taxed regardless of repatriation. Explanation: under the U.S. worldwide taxation system, U.S. corporations are subject to tax on their worldwide income, but certain foreign income is deferred until repatriated. However, Subpart F income under ERSS 951-965 mandates immediate taxation on specific earnings of controlled foreign corporations (CFCs), even if the income remains offshore. A. Incorrect. The U.S. system allows some deferral of taxation for foreign subsidiaries unless the income falls under Subpart F rules or global intangible low-taxed income. Guilty. C. Incorrect. Corporation cannot fully exclude foreign earnings from U.S. tax simply by setting up subsidiaries in lower tax countries as the IRA applies anti-deferral rules. CFC. Guilty. D. Incorrect. Tax treaties provide benefits but do not override core U.S. tax laws, especially regarding CFC taxation. The company must ensure compliance with FATCA CFC rules and guilty provisions to prevent penalties for non-reporting. Question 5. In a case where multiple parties have different objectives a high net worth individual is considering a tax-efficient estate planning strategy to minimize estate and gift tax liability while providing for their heirs. The taxpayer is weighing the benefits of a grant or retained annuity trust, GRA, an irrevocable life insurance trust, ILIT, and direct gifting strategies. Given current IRA rules on estate and gift taxation, what is the tax-efficient approach in terms of minimizing estate tax liability? A. Establishing an irrevocable life insurance trust, ILIT, to remove the life insurance proceeds from the taxable estate. B. Using a GRAT to transfer appreciating assets at a discounted value, avoiding gift tax entirely. C. Directly gifting assets exceeding the annual exclusion limit to heirs while avoiding gift tax reporting. D. Retaining control over all assets until death to take advantage of the step-up in basis and eliminate all tax liability. Answer: A. Establishing an irrevocable life insurance trust, ILIT, to remove the life insurance proceeds from the taxable estate. Explanation: An irrevocable life insurance trust, ILIT, is a widely used estate planning tool because it removes life insurance proceeds from the taxable estate provided that the trust is properly structured and the insured does not retain incidents of ownership. A. Correct. ILITs are designed to hold life insurance policies, keeping the proceeds outside the taxable estate under ERSSS 2042. B. Incorrect. GRAT ERSSS 2702 allows discounted transfers, but it does not completely avoid gift tax. It depends on the grantor's annuity interest period. C. Incorrect. Gifts exceeding the annual exclusion $17,000 for 2023 require gift return Form 709 and may use the lifetime gift exemption. D. Incorrect. Step up in basis applies to appreciated assets upon death, but it does not eliminate estate tax, which applies to estates above the exemption limit $12.92 million for 2023. Estate planning should balance gift tax, estate tax, and capital gains considerations to achieve the most tax-efficient outcome. Question 6. While analyzing the root causes of sequential problems in a business's tax filings, CPA discovers that client, sole proprietor, has been incorrectly classifying independent contractors as employees. The IRS has issued notice proposing reclassification and potential penalties. Which of the following IRF factors is the most critical in determining whether worker is an employee or an independent contractor? A. Whether the worker uses their own tools and equipment. B. Whether the employer provides benefits like health insurance and paid leave. C. The degree of control the employer has over how, when, and where the work is performed. D. The length of the worker's contract with the employer. Answer: C. The degree of control the employer has over how, when, and where the work is performed. Explanation: The IRS is a control test to distinguish employees from independent contractors. The most important factor is the level of control the employer has over the worker's performance. A. Incorrect. While using personal tools is factor, it is not determinative under IRS common law rules. B. Incorrect. Benefits suggest employee status but are not the primary determinant. C. Correct. The degree of control over the work performed is the primary factor under IRS Obligation 15A. More control indicates employee classification. D. Incorrect. Contract length does not define employment status under IRS guidelines. Misclassification leads to FICA tax liabilities, penalties, and back wages under the Fair Labor Standards Act FLSA. Question 7. When developing a solution that must address opposing needs, a corporation with international operations must determine how to allocate and apportion business income for state tax reporting purposes. The company has sales, payroll, and property in multiple states, and its income is subject to apportionment rules under the Uniform Division of Income for Tax Purposes Act UDIPA. Which of the following apportionment methods is most common used to allocate income across states? A. The three-factor formula based on sales, property, and payroll in each state. B. The single sales factor formula, which apportions income solely based on sales in the state. C. The market-based sourcing method, which allocates income based on the customer's location. D. The origin-based sourcing method, which allocates income based on where the service was performed. Answer: A. The three-factor formula based on sales, property, and payroll in each state. Explanation: most states follow UDIPA's three-factor formula, which apportions taxable income based on the percentage of corporation sales, property, and payroll within the state. A. Correct. The three-factor formula is historically the most commonly used method for state income tax apportionment. B. Incorrect. Some states use single sales factor apportionment, but it is not universal. C. Incorrect. Market-based sourcing applies mostly to service-based businesses and is used in some states, but not all. D. Incorrect. Origin-based sourcing is less common and does not align with most state tax laws. Understanding state tax apportionment is critical for multi-state business compliance and minimizing state tax liability. Question 8. When faced with an unexpected change in circumstances, a corporation that operates internationally discovers that one of its key subsidiaries is being audited by the IRS for potential transfer pricing violations. The IRS alleges that the company has been shifting profits to lower tax jurisdictions to reduce U.S. taxable income. Given the arm's length principle under IRA regulations, which of the following actions is the most effective way for the corporation to demonstrate compliance and avoid penalties? A. Submitting contemporaneous transfer pricing documentation that proves intercompany transactions were priced according to market rates. B. Reclassifying all intercompany transactions as cost-sharing agreements to avoid IRS scrutiny. C. Claiming that transfer pricing adjustments do not apply because the subsidiary operates as an independent foreign entity. D. Voluntarily paying additional taxes on transferred profits to satisfy IRS's concerns. Answer. A. Submitting contemporaneous transfer pricing documentation that proves intercompany transactions were priced according to market rates. Explanation. The arm's length principle under IRS 482 requires that intercompany transactions between related entities be priced as if they were between unrelated parties in an open market. The IRS scrutinizes transfer pricing to ensure that multinational corporations not shifting profits to avoid taxes. A. Correct contemporaneous documentation is the most effective defense against IRS penalties. The IRS expects businesses to provide detailed transfer pricing studies including comparables, economic analyses, and functional characterizations of related entities. B. Incorrect. Cost-sharing agreements must be structured properly under Treasury Regulations SS.4827. Reclassifying transactions after an audit trigger additional scrutiny. C. Incorrect. The IRS applies transfer pricing rules even to subsidiaries in foreign jurisdictions if they meet control and ownership tests. D. Incorrect. Voluntarily paying taxes may not resolve the underlying compliance issues, and it does not eliminate potential penalties. Multinational companies must ensure proper documentation, benchmarking studies, and compliance with OAT and U.S. transfer pricing rule to avoid penalties. Question 9. While managing a situation where time is limited, a taxpayer realizes they have incorrectly reported capital gains on their tax return and are now facing a potential IRA audit. The taxpayer originally reported the sale of stock as a short-term capital gain instead of a long-term capital gain, which has resulted in a higher tax liability. What is the most effective course of action for the taxpayer to take in order to correct the mistake and minimize penalties? A. Filing an amended tax return, Form 1040X, as soon as possible to correct the capital gains classification. B. Waiting for the IRS to detect the mistake and then providing an explanation during the audit. C. Claiming that the mistake was unintentional and requesting an automatic correction without penalty. D. Refiling the original return with the correct capital gains classification before the IRS processes the return. Answer. A. Filing an amended tax return, Form 1040X, as soon as possible to correct the capital gains classification. Explanation. When the taxpayer discovers an error in their tax return, the best approach is to proactively correct it by filing Form 1040X, amended U.S. individual income tax return, before an IRS audit begins. A. Correct. The IRS allows taxpayers to amend returns within 3 years from the original filing date or 2 years from the date of tax payment. Correcting errors before an audit can reduce penalties and interest. B. Incorrect. Waiting for an IRS audit increases the risk of additional penalties and interest. The IRS may also classify the mistake as negligence or fraudulent misrepresentation if not voluntarily corrected. C. Incorrect. The IRS does not allow for automatic corrections in cases of misreported capital gains if a formal amendment is required. D. Incorrect. Once a return has been filed, resubmitting the original form does not override the initial submission. The IRS will still process the first return and flag discrepancies. By filing Form 1040X promptly and providing accurate documentation, taxpayers can reduce their tax burden and avoid scrutiny. Question 10. During a period of transition that affects multiple stakeholders, a business undergoing a corporate restructuring must determine the tax consequences of liquidating a subsidiary. The parent company owns 100% of the subsidiary stock and liquidation is planned under ERSS 332, which governs complete liquidations of subsidiaries. What is the primary tax implication of this type of liquidation? A. The subsidiary's assets transfer to the parent company tax-free and no gain or loss is recognized. B. The parent company must recognize gain or loss on the fair market value of the subsidiary's distributed assets. C. The subsidiary is taxed on all gains from asset distribution, but the parent company is exempt. D. The liquidation is treated as taxable event, requiring both the parent and subsidiary to pay corporate income tax. Answer: A. The subsidiary's assets transfer to the parent company tax-free and no gain or loss is recognized. Explanation: under ERSS 332, if parent company owns at least 80% of subsidiaries' stock and completely liquidates the subsidiary, the asset transfer is tax-free. A. Correct. No gain or loss is recognized by the parent or subsidiary, making it tax-efficient way to restructure corporate entities. B. Incorrect. The parent company does not recognize gain or loss in qualifying liquidation under ERSS 332. C. Incorrect. The subsidiary does not recognize gain or loss under ERSS 337, provided that the liquidation meets the ownership threshold. D. Incorrect. Applies only to taxable liquidations where ERSS 337 do not apply. Corporate restructurings should be carefully planned to maximize tax efficiency while ensuring compliance with IRA rules. Question 11. When handling a situation involving multiple legal and financial considerations, a multinational corporation is considering relocating its headquarters from the United States to a lower tax jurisdiction. Under the Internal Revenue Code, what are the potential tax consequences of this move, and how can the corporation minimize its U.S. tax liability? A. The corporation will be subject to the ERSS 7874, which may classify it as U.S. entity for tax purposes, limiting its ability to avoid U.S. taxation. B. The corporation can immediately cease paying U.S. taxes by reincorporating in foreign jurisdiction as long as it maintains less than 50% U.S. ownership. C. The corporation will not be subject to U.S. exit taxes as long as it continues to generate revenue from non-U.S. sources. D. The corporation must liquidate all U.S. based assets before moving its headquarters to avoid U.S. taxation. Answer: A. The corporation will be subject to the ERSS 7874, which may classify it as U.S. entity for tax purposes, limiting its ability to avoid U.S. taxation. Explanation: under ERSS 7874, if U.S. corporation relocates its headquarters to foreign country but continues to be at least 80% owned by U.S. shareholders, it will still be treated as U.S. corporation for tax purposes. A. Correct. S. The IRA applies anti-inversion rules to prevent corporations from avoiding U.S. taxes through artificial relocations. B. Incorrect. Ownership structure is critical. If U.S. shareholders own 60% to 79% of the new foreign entity, certain tax penalties still apply. C. Incorrect. U.S. tax rules apply to all income generated by corporation classified as U.S. entity, regardless of source. D. Incorrect. Liquidation does not exempt company from exit tax obligations under ERSS 367 and SS 965. To minimize liability, corporations should carefully structure foreign mergers and ownership percentages before attempting an inversion. Question 12. While navigating a rapidly changing regulatory environment, an investment firm managing hedge funds is reviewing the impact of the Tax Cuts and Jobs Act (ECJA) of 2017 on carried interest taxation. How does this law affect hedge fund managers' tax treatment of carried interest? A. It increased the required holding period for long-term capital gains treatment from 1 year to 3 years for carried interest. B. It eliminated the preferential long-term capital gains rate for carried interest, treating it as ordinary income. C. It allowed hedge fund managers to defer taxation of carried interest indefinitely if reinvested. D. It required hedge funds to distribute carried interest annually to be eligible for capital treatment. Answer: A. It increased the required holding period for long-term capital gains treatment from 1 year to 3 years for carried interest. Explanation: the Tax Cuts and Jobs Act (ECJA) of 2017 extended the holding period for carried interest to 3 years to qualify for long-term capital gains rates. A. Correct. Hedge fund managers must now hold assets for 3 years instead of 1 year to benefit from the preferential 20% long-term capital gains rate under ERSS 1061. B. Incorrect. Carried interest is still eligible for capital gains treatment, but with the new 3-year requirement. C. Incorrect. The TCJA did not allow indefinite deferral of carried interest taxation. D. Incorrect. Distribution timing determine capital gains treatment. Holding period matters. Fund managers should carefully plan investment strategies to avoid higher short-term capital gains tax rates up to 37%. Question 13. When analyzing a complex financial scenario involving taxation, an individual investor who holds Series E savings bonds wants to cash them out and use the proceeds for educational expenses under ERA rules. What tax benefit may be available? A. Interest earned may be excluded from taxable income if used for qualified higher education expenses under the Education Savings Bond Program. B. The total bond proceeds, including principal and interest, are always tax-free regardless of how they are used. C. The interest is taxed at the capital gains rate if reinvested within 60 days in a 529 plan. D. The interest must be reported as ordinary income unless the investor is over age 65. Answer: A. Interest earned may be excluded from taxable income if used for qualified higher education expenses under the Education Savings Bond Program. Explanation: the Education Savings Bond Program, or SSS 135, allows individuals to exclude interest income from Series E and I bonds if the proceeds are used for qualified educational expenses. A. Correct. To qualify, the bondholder must meet income limits and use the funds for tuition and fees at an eligible institution. B. Incorrect. Only the interest portion may be tax exempt under specific conditions. C. Incorrect. There is no provision allowing 529 plan reinvestment for tax-free treatment. D. Incorrect. Age does not determine taxability. Eligibility is based on usage and income limits. Investors should review Form 8815 instructions to properly claim this exemption. Question 14. During a period of heightened economic uncertainty, a business is considering electing S corporation status to reduce its tax burden. What are the primary tax benefits and limitations of this election? A. The business avoids double taxation as profits are passed through to shareholders and taxed at individual rates. B. The business must pay corporate income tax, but shareholders avoid tax on distributed profits. C. The business can have an unlimited number of shareholders, including foreign investors. D. The business must distribute all profits annually to shareholders to maintain S corporation status. Answer: A. The business avoids double taxation as profits are passed through to shareholders and taxed at individual rates. Explanation: electing S corporation status under SSS 1361-1379 allows businesses to avoid double taxation by passing income, losses, and deductions directly to shareholders. A. Correct. S corporations do not pay corporate income tax, reducing overall tax liability. B. Incorrect. Unlike C corporations, S corporations do not pay federal corporate tax. C. Incorrect. S corporations are limited to 100 shareholders and foreign investors cannot own shares. D. Incorrect. Profits do not have to be distributed annually. Income is taxed regardless of distribution. Businesses considering this election should evaluate ownership restrictions and self-employment tax implications. Question 15. While evaluating potential business risks in a global market, a U.S. based corporation is expanding its operations into multiple foreign countries. What are the key tax implications it must consider under the Foreign Account Tax Compliance Act, FATCA? A. The corporation must report all foreign financial assets over $50,000 to the IRS, and failure to comply results in a 30% withholding tax on certain payments. B. The corporation is exempt from FATCA reporting if its foreign earnings are below $1 million annually. C. Only foreign financial institutions, FIS, are responsible for compliance with FATCA, not U.S. based businesses. D. FATCA applies only to individual taxpayers and businesses expanding internationally are not affected. Answer: A. The corporation must report all foreign financial assets over $50,000 to the IRS, and failure to comply results in a 30% withholding tax on certain payments. Explanation: the Foreign Account Tax Compliance Act, FATCA, is a U.S. law requiring businesses and individuals to report certain foreign assets to the IRS. Correct. U.S. corporations must report foreign assets over $50,000, and non-compliance leads to a 30% withholding tax on payments from U.S. sources to non-compliant foreign institutions. B. Incorrect. There is no blanket exemption based on annual earnings. All U.S. entities with foreign holdings must comply. C. Incorrect. While foreign financial institutions FIS must report U.S. accounts, U.S. businesses with foreign accounts must also report them under Form 8938. D. Incorrect. FAQ applies to both individuals and businesses with foreign assets. To ensure compliance, corporations should work with tax professionals and file Form 8938 and FBAR, FinCEN 114 as needed. Question 16. When making a critical financial decision involving retirement planning, an individual is deciding between a Roth IRA and a traditional IRA for long-term savings. How do the tax implications differ between these two accounts? A. Contributions to a traditional IRA are tax deductible, but withdrawals in retirement are taxed as ordinary income. B. A Roth IRA allows tax-free contributions, but withdrawals are subject to capital gains tax rates. C. Both. A traditional IRA and a Roth IRA provide tax-free withdrawals in retirement. D. Withdrawals from a traditional IRA before age 591 were always tax-free as long as they are used qualified medical expenses. Answer. A. Contributions to a traditional IRA are tax deductible, but withdrawals in retirement are taxed as ordinary income. Explanation. The main difference between a traditional IRA and a Roth IRA is when taxes are paid. A. Correct. Contributions to a traditional IRA may be tax deductible, but withdrawals are taxed as ordinary income at retirement. B. Incorrect. A Roth IRA allows tax-free withdrawals in retirement if certain conditions are met. Contributions are after tax, not tax-free. C. Incorrect. Only Roth IRAs offer tax-free withdrawals. A traditional IRA withdrawals are taxed. D. Incorrect. Early withdrawals from a traditional IRA before age 191 are usually subject to 10% penalty unless an exception applies. For those expecting higher tax bracket in retirement, Roth IRA is often more beneficial. Question 17. While considering the impact of federal estate tax laws on wealth transfer, an individual with a $15 million estate wants to minimize estate taxes for their heirs. What are the best legal strategies available? A. Using the lifetime exemption, which in 2024 allows individuals to transfer up to $13.61 million tax-free. B. Transferring all assets through a last will and testament to avoid federal estate taxes. C. Using a qualified personal residence trustee to immediately eliminate estate tax liability. D. Gifting unlimited amounts to heirs annually to fully avoid estate tax implications. Answer. A. Using the lifetime exemption, which in 2024 allows individuals to transfer up to $13.61 million tax-free. Explanation. The federal estate tax exemption allows individuals to transfer a certain amount of wealth tax-free during their lifetime or upon death. A. Correct. The 2024 exemption is $13.61 million per individual, meaning that a married couple can shield up to $27.22 million from estate taxes. B. Incorrect. A will does not eliminate estate tax liability. Assets in an estate over the exemption amount may be taxed at 40%. C. Incorrect. A qualified personal residence trustee can reduce estate value, does not eliminate estate tax entirely. D. Incorrect. The annual gift tax exclusion, $18,000 per recipient in 2024, allows tax-free gifts, but it does not eliminate estate tax on large estates. For large estates, trusts, gifting strategies, and exemptions should be carefully planned to reduce tax liability. Question 18. While examining the tax implications of real estate investments, a taxpayer is considering a 1031 exchange to defer capital gains tax. What are the key requirements for a successful 1031 exchange? A. The replacement property must be of like kind and identified within 45 days, with the transaction completed within 180 days. B. The investor can cash out the profit and still defer capital gains taxes. C. The replacement property must be located in the same state as the relinquished property. D. The investor must hold the replacement property for at least 10 years to qualify. Answer. A. The replacement property must be of like kind and identified within 45 days, with the transaction completed within 180 days. Explanation. A 1031 exchange under IRS 1031 allows investors to defer capital gains taxes on real estate transactions. A. Correct. The new property must be like kind, identified within 45 days, and acquired within 180 days of selling the original property. B. Incorrect. If the investor cashes out any portion of the sale, that portion is immediately taxable. B. C. Incorrect. The replacement property can be anywhere in the U.S., not necessarily in the same state. D. Incorrect. There is no 10-year holding requirement, but the IRA expects investors to hold the property for a reasonable period. 1031 exchanges help real estate investors defer taxes and grow investments, but strict compliance is required. Question 19. While determining the tax treatment of business expenses, the self-employed consultant is evaluating which expenses qualify as deductible under ERSSS 162. Which of the following expenses is fully deductible? A. Home office used exclusively for business. B. Business meals with client, which are 100% deductible. C. The purchase of luxury car used for both personal and business use. D. Employee gifts worth over $500 per person. Answer A. A home office used exclusively for business. Explanation. Under ERSSS 162, business expenses must be ordinary and necessary to qualify for deduction. A. Correct. Home office is deductible if used exclusively for business under ERSSS 280. B. Incorrect. Business meals are only 50% deductible, not 100%. C. Incorrect. The cost of luxury car is subject to depreciation limits under ERSSS 280. D. Incorrect. Employee gifts over $25 per person are not fully deductible. Self-employed taxpayers should maintain D. Records to substantiate business expenses. Question 20. When assessing the impact of federal tax laws on corporate financial planning, a publicly traded company is considering issuing stock options to its executives. What are the key tax implications of incentive stock options, ISOs, versus non-qualified stock options, NSOS? A. ISOs provide preferential tax treatment if held for at least 1 year from exercise and 2 years from grant. B. NSOS are always taxed at long-term capital gains rates when exercised. C. ISOs require the company to withhold payroll taxes upon exercise. D. NSOS and ISOs are taxed identically at the time of grant. Answer A. ISOs provide preferential tax treatment if held for at least 1 year from exercise and 2 years from grant. Explanation. Stock options are a common form of executive compensation, but their tax treatment varies. A. Correct. Incentive stock options, ISOs, qualify for long-term capital gains treatment if the stock is held for at least 1 year after exercise and 2 years after grant. B. Incorrect. Non-qualified options, NSOS, are taxed as ordinary income upon exercise, not long-term capital gains. C. Incorrect. ISOs do not require payroll tax withholding upon exercise. The SOS do. D. Incorrect. ISOs and NSOS are not taxed at the time of grant, only when exercised. Companies must carefully design equity compensation plans to optimize tax efficiency for both the business and employees. Question 21. While analyzing the implications of tax treaties on international business, a U.S. company with operations in Germany wants to understand how the U.S.-Germany tax treaty affects double taxation on income earned abroad. What key provisions apply? A. The treaty allows for foreign tax credits to offset U.S. tax liability. B. The U.S. taxes all foreign income at a flat 21% corporate rate regardless of treaties. C. The treaty eliminates all U.S. tax obligations on foreign earned income. D. Companies must pay full taxes in both Germany and the U.S. with no relief. Answer A. The treaty allows for foreign tax credits to offset U.S. tax liability. Explanation. The U.S.-Germany tax treaty helps avoid double taxation and ensures fair taxation of multinational corporations. A. Correct. The treaty allows U.S. companies to claim foreign tax credits to offset U.S. tax liability for income already taxed in Germany. B. Incorrect. The corporate tax rate is 21%, but foreign tax credits reduce double taxation. C. Incorrect. The treaty does not eliminate all U.S. tax obligations, but it reduces them through credits. D. Incorrect. Companies do not have to pay full taxes in both countries due to tax credits and treaty provisions. Proper tax treaty planning is essential for global businesses to minimize tax burdens. Question 22. When considering the tax consequences of employee benefits, an employer is offering a 401k match program. What are the tax benefits for both the employer and employees? A. Employers can deduct matching contributions as a business expense. B. Employees must immediately pay taxes on employer matching contributions. C. Employer contributions are subject to payroll taxes when deposited. D. Employees cannot make Roth 401k contributions if an employer match is offered. Answer A. Employers can deduct matching contributions as a business expense. Explanation. A 401k plan provides tax advantages to both employees and employers. Correct. Employer matching contributions are fully tax deductible as a business expense. B. Incorrect. Employees do not pay taxes on employer matches until withdrawal for traditional 401k plans. C. Incorrect. Employer contributions are exempt from payroll taxes but are subject to withdrawal taxation. D. Incorrect. Employees can contribute to Roth 401ks but employer contributions always a traditional 401k. The 401k plan helps both employers and employees save on taxes while preparing for retirement. Question 23. While exploring the tax implications of cryptocurrency transactions, a taxpayer sells Bitcoin for a profit. How is the gain reported for tax purposes? A is capital gains income subject to short-term or long-term tax rates. B is ordinary income taxed at the taxpayer's highest marginal rate. C is tax-free income since cryptocurrencies are decentralized assets. D is a foreign currency transaction subject to special reporting rules. Answer: A is capital gains income subject to short-term or long-term tax rates. Explanation: the IRS treats cryptocurrency as property, meaning gains are taxed as capital gains. A. Correct. If the Bitcoin was held for over a year, it's taxed as long-term capital gains 0%, 15%, or 20%. If held less than a year, it's taxed as short-term capital gains ordinary tax rates. B. Incorrect. Cryptocurrency is not treated as ordinary income unless earned as wages. C. Incorrect. Crypto gains are taxable in the U.S. D. Incorrect. Cryptocurrencies are not foreign currency, so special foreign tax rules do not apply. Crypto traders must keep detailed records for accurate tax reporting. Question 24. When assessing the tax treatment of business travel expenses, what are the IRLs for deducting travel costs? A. Travel must be primarily for business, with only incidental personal activities. B. Personal travel expenses are fully deductible if combined with a business trip. C. First-class airfare is never deductible for business travel. D. Business travel deductions are limited to 25% of total expenses. Answer: A. Travel must be primarily for business, with only incidental personal activities. Explanation: the IRS allows business travel deductions under strict conditions. A. Correct. Travel must be primarily business-related, with any personal time being incidental. B. Incorrect. Personal travel is never deductible, even if combined with business. C. Incorrect. First-class airfare is deductible as long as it's ordinary and necessary. D. Incorrect. There is no 25% limit. 100% of qualifying travel expenses can be deducted. Proper documentation, receipts, itineraries is key to avoiding IRS scrutiny. Question 25. While considering the impact of state tax laws on business income, how do state corporate taxes differ across jurisdictions? A. Some states do not impose corporate income taxes. B. All states tax corporate income at a flat 5% rate. C. Corporate taxes are always based on federal taxable income without adjustments. D. Businesses must pay the same corporate tax rate in every state where they operate. Answer: A. Some states do not impose corporate income taxes. Explanation: state corporate tax laws vary widely. A. Correct. Some states like Wyoming and South Dakota have no corporate income tax. B. Incorrect. Rates vary significantly. G. California's is 8.84%, while Texas has none. C. Incorrect. Many states modify federal taxable income for state-specific deductions or credits. D. Incorrect. Operating in multiple states face apportionment rules, leading to different tax rates. State tax planning is essential for corporate profitability. Question 26. While evaluating the role of depreciation in tax planning, a business purchases a new delivery truck for $50,000. How can it use depreciation to reduce taxable income under MACA's modified accelerated cost recovery system? A. The truck is depreciated over 5 years using accelerated depreciation. B. The truck is fully deductible in the year of purchase. C. The truck is depreciated using the straight-line method over 20 years. D. The business cannot claim depreciation unless the vehicle is fully paid off. Answer: A. The truck is depreciated over 5 years using accelerated depreciation. Explanation: depreciation allows businesses to recover costs over time, reducing taxable income. A. Correct. Under MACA's, vehicles like trucks are typically classified as 5-year property and qualify for accelerated depreciation. G. 200% declining balance method. B. Incorrect. Some assets may qualify for Section 179 or bonus depreciation, but not all assets are fully deductible in the year of purchase. C. Incorrect. The straight line method is optional but is not required over 20 years for vehicles. D. Incorrect. Depreciation begins when the asset is placed in service, not when fully paid off. Macas allows businesses to accelerate deductions for major purchases, improving cash flow. Question 27. When determining the tax implications of business mergers and acquisitions, how does the IRS classify a stock purchase versus an asset purchase? A stock purchases transfer the company's liabilities to the buyer. B. Asset purchases allow the buyer to inherit the seller's tax history. C. Stock purchases qualify for immediate depreciation deductions on acquired assets. D. Asset purchases are always tax-free for the seller. Answer: A. Stock purchases transfer the company's liabilities to the buyer. Explanation: mergers and acquisitions can take the form of stock or asset purchases, each with unique tax effects. A. Correct. Stock purchase means the buyer inherits all liabilities and tax attributes of the company. B. Incorrect. In an asset purchase, the buyer gets step up in asset basis but not the seller's tax history. C. Incorrect. Stock purchases do not allow immediate depreciation of assets. The company retains its existing asset basis. D. Incorrect. Asset sales may result in capital gains tax for the seller. Buyers and sellers must carefully structure deals for optimal tax benefits. Question 28. While analyzing the tax treatment of employer-sponsored health plans, what are the key tax benefits of offering a health savings account (HSA) to employees? A. Contributions are tax deductible for the employer and tax-free for employees. B. HSA funds must be used within the same tax year or forfeited. C. HSA withdrawals for any purpose are tax-free. D. Employees cannot make additional contributions beyond employer funding. Answer: A. Contributions are tax deductible for the employer and tax-free for employees. Explanation: HSAs provide triple tax benefits. A. Correct. Employer contributions are tax deductible and employee contributions are pre-tax, reducing taxable income. B. Incorrect. HSAs do not expire yearly, unlike FSAs, which have a use it or lose it rule. C. Incorrect. Withdrawals are only tax-free for qualified medical expenses. Non-medical withdrawals are taxed plus 20% penalty. D. Incorrect. Employees can contribute up to annual RL limits, even if employers also contribute. HSAs are valuable for tax planning and long-term healthcare savings. Question 29. When considering the tax implications of self-employment income, how should independent contractors report business expenses to maximize deductions? A. Business expenses must be reported on Schedule C of Form 1040. B. Self-employed individuals must use itemized deductions instead of business deductions. C. Only expenses over $2,500 per year can be deducted. D. Self-employed individuals cannot deduct home office expenses. Answer: A. Business expenses must be reported on Schedule C of Form 1040. Explanation: self-employed individuals filed Schedule C to report business income and deductions. A. Correct. Schedule C, profit or loss from business, allows contractors to deduct expenses like supplies, travel, and advertising. B. Incorrect. Business expenses are separate from itemized deductions, e.g. mortgage interest, medical expenses. C. Incorrect. There is no minimum expense limit. Even $100 business purchases are deductible. D. Incorrect. Home office expenses are deductible if the space is used exclusively for business. Proper record keeping is essential for IRS compliance. Question 30. While evaluating the tax implications of charitable contributions, how can individuals and businesses maximize deductions? A. Donations to qualified 501. C. 3. Charities are tax deductible. B. The IRS allows unlimited charitable deductions. C. Businesses can deduct 100% of charitable contributions, regardless of income. D. Only cash donations qualify for tax deductions. Answer: A. Donations to qualified 501. C. 3. Charities are tax deductible. Explanation: charitable contributions provide tax benefits, but rules apply. A. Correct. Donations must be made to IRS-approved 501 C3 organizations to be deductible. B. Incorrect. There are limits, e.g. 60% of OGI for individuals, 25% for corporations. C. Incorrect. Businesses deduct more than their taxable income. D. Incorrect. Non-cash donations like stocks or real estate can also be deducted at fair market value. Strategic giving can reduce tax liability while supporting causes.